Hi, today I'll be talking about a topic that is deeply rooted in the foreign exchange market and helps us better understand the concept of exchange rates. This theory is called the interest rate parity. For starters, what is the interest rate parity, you may ask? Interest rate parity is a theory that the interest rate differential between two countries is equal to the differential between the forward exchange rate and the spot exchange rate. Or in simple terms, it is the fundamental equation that governs the relationship between interest rates and currency exchange rates. Moreover, this theory mainly focuses on the forward exchange rate and the spot exchange rate. So, the spot exchange rate is basically how much you could exchange for one currency for another right now, while the forward exchange rate is the agreed upon price for exchanging one currency for another at a future date. Now, with the definitions out of the way, if we go back to the interest rate parity, to summarize, this theory states that the difference between the forward and spot exchange rates must be equal to the interest rate differential between the two countries. It should also be stated that this parity suggests that higher interest rate currencies tend to depreciate against lower interest rate currencies and vice versa, shown by the scatter plot I made using data on the interest rate of countries from trading economics. The graph basically shows whether a country depreciates or appreciates when going against the Canadian dollar. Now, let's examine the interest rate parity formula, where F is the forward exchange rate, S is the spot exchange rate, IA is the interest rate of country A, or the price currency as a price currency interest rate, as it is the currency of the country being exchanged for. And lastly, IB is the interest rate of country B, or the base currency interest rate, as it is the currency of the country which you started out with. We can easily look for any of these variables simply by playing around with the formula. For example, if you wanted to look for the spot rate, you would just divide the forward rate by 1 plus IA over 1 plus IB. Now, let's take a look at this example. It's telling us to calculate the 1 year forward rate for CAD to USD, given the following information. We know that the spot rate for 1 CAD to USD is 70 cents, and the two exchange rates of the countries are also given. Using this info, we would just plug them into the interest rate parity formula to find the 1 year forward rate for CAD to USD. And since we are exchanging for CAD for USD, the Canadian interest rate will be used as the base interest rate in our formula, putting it at the bottom of the fraction. After plugging the numbers in the formula and calculating the equation, we should get around 0.70677 cents, meaning I would agree to exchange today with you CAD to USD, 1 Canadian dollar, and a year from now, you would give me 0.70677 US dollar cents. With these numbers, you can easily see that the Canadian dollar has appreciated within this time frame, or in other words, it became more valuable because before 1 Canadian dollar could only exchange for 70 cents USD. But now you would agree, you could argue that 1 Canadian dollar can be exchanged for 71 cents USD. Thus, this aligns with the interest rate parity, since the lower interest rate currency, the Canadian dollar, appreciated against the higher interest rate currency, the US dollar. Hypothetically, let's say the question earlier had asked us to calculate the 5-year forward rate of CAD to USD. How would the formula have changed? The formula would have an exponent of t years around the fractions, but generally, if we are doing calculations for 1 year, the t variable can be omitted because it doesn't affect the overall equation. Now that we have a pretty good understanding of the interest rate parity theory, how the formula works, we come to the question of what happens if the interest rate parity doesn't hold. In other words, what happens if the difference between the forward and spot exchange rates does not match the interest rate differential. Then, in this case, an arbitrage opportunity exists. An arbitrage is when an asset is bought in one market and sold in another for a higher price. In the case of interest rate parity, investors may use either covered interest rate arbitrage or uncovered interest rate arbitrage. Uncovered being more risky as there's no pre-discussed forward contract. And these contracts are basically used so that there is no risk of currency depreciation over time. For example, let's pretend that the US interest rate is lower than the UK interest rate. A trader would borrow money in USD for a low interest rate and then convert to GBP, and they would then invest in the UK at their higher interest rate. After that, depending on if they used a forward contract prior to the conversion, when converting back to USD, they would have made profit after paying back the loan that they originally had from the US. Although this shines the interest rate parity theory in a bad light, in reality, interest rate parity rarely holds perfectly because of real world factors like transaction costs, market friction, capital controls, and risk premiums often cause deviations. But over time, financial markets tend to push exchange rates towards equilibrium. In conclusion, interest rate parity is still a really good guiding principle for exchange rate behaviors. Thank you so much for watching. Here are my sources.